Section 5.2 Understanding Standard Deviation, Risk Management and Portfolio Optimization. Standard deviation can be applied in risk management strategies to set stop-loss levels and implement hedging techniques. Here's how it can be used. Stop-loss levels. Stop-loss levels are predetermined price levels at which an investor exits a position to limit potential losses. Standard deviation can help determine appropriate stop-loss levels by providing a measure of price volatility. A wider standard deviation suggests higher price volatility and may warrant setting wider stop-loss levels to account for potential fluctuations. Conversely, a narrower standard deviation suggests lower volatility, allowing for tighter stop-loss levels. By incorporating standard deviation, investors can set stop-loss levels that align with their risk tolerance and the expected price movements. Hedging techniques. Hedging involves taking positions to offset potential losses in an investment. Standard deviation can aid in selecting appropriate hedging techniques. When hedging, investors typically look for investments or strategies negatively correlated with their existing positions. By analyzing the standard deviation of potential hedging instruments, investors can identify those with lower volatility that may effectively offset the risks of the primary investment. The lower the standard deviation of the hedging instrument, the more stable and predictable its performance may be. Encountering potential losses. Volatility-based position sizing. Standard deviation can also guide position sizing in a portfolio. Investors can allocate capital to different investments based on their standard deviation. Higher standard deviation investments may warrant smaller position sizes to limit the overall portfolio's exposure to volatility. Conversely, lower standard deviation investments may allow for larger position sizes. By adjusting position sizes based on the standard deviation, investors can manage risk more effectively and maintain a balanced portfolio. Risk-adjusted return. Standard deviation is often used in risk-adjusted return metrics such as the Sharpe ratio or Sortino ratio. These ratios evaluate an investment's performance relative to its volatility. By incorporating standard deviation, risk-adjusted ratios provide insights into the risk-adjusted returns of investments, helping investors assess the potential return per unit of risk. This information can guide decision-making, enabling investors to compare investments and choose those with higher risk-adjusted returns. Stress testing. Stress testing involves analyzing the potential impact of adverse market conditions on investments. Standard deviation can be used to model different stress scenarios by increasing the volatility parameter. By stress testing portfolios based on higher standard deviations, investors can assess the potential losses and evaluate the resilience of their investments under extreme conditions. This analysis helps identify vulnerabilities and implement appropriate risk mitigation strategies. It's important to note that standard deviation is not the sole determinant of risk management strategies. Other factors, such as market conditions, individual investment characteristics, and investor risk tolerance, should also be considered. Additionally, standard deviation assumes a normal distribution of returns, which may not accurately capture all types of risks. It's advisable to incorporate other risk measures and perform comprehensive risk analysis when implementing risk management strategies. Standard deviation is a valuable tool in portfolio optimization models to achieve desired risk levels. By incorporating standard deviation, investors can construct portfolios that align with their risk preferences and objectives. Here's how standard deviation can be utilized in portfolio optimization. Risk constraints. Standard deviation can be used as a risk constraint in portfolio optimization models. Investors can set a maximum acceptable standard deviation or target a specific level of risk for their portfolio. By including this constraint, the optimization process seeks to generate an optimal portfolio that achieves the desired risk level. This ensures that the resulting portfolio meets the investor's risk tolerance and helps avoid excessive volatility. Risk-return trade-off. Standard deviation is often used as a measure of risk in the objective function of portfolio optimization models. The objective function seeks to maximize the portfolio's expected return while minimizing its standard deviation. By incorporating standard deviation, the optimization process balances the trade-off between risk and return. It helps identify portfolios that provide the best risk-adjusted returns, where the expected return is maximized for a given level of risk. Efficient frontier. Standard deviation plays a crucial role in constructing the efficient frontier in portfolio optimization. The efficient frontier represents the set of portfolios that offer the highest expected return for each level of risk. Standard deviation is plotted on the x-axis, representing the risk measure, while expected return is plotted on the y-axis. By utilizing standard deviation, investors can explore various portfolios on the efficient frontier and choose the one that matches their desired risk level. Sensitivity analysis. Standard deviation can be used in sensitivity analysis within portfolio optimization. By adjusting the standard deviation inputs or assumptions, investors can assess the impact on the optimal portfolio composition. Sensitivity analysis helps understand how changes in risk levels affect the portfolio's asset allocation. Investors can determine the trade-offs between different risk levels and adjust their preferences accordingly. Constraints for asset classes or sectors. Standard deviation can be employed as a constraint for specific asset classes or sectors within the portfolio. Investors may have preferences for limiting the risk exposure to certain asset classes or sectors. By incorporating standard deviation as a constraint, the optimization model ensures that the allocation to those asset classes or sectors remains within acceptable risk bounds. Monte Carlo simulation. Standard deviation is often used in Monte Carlo simulations to generate a range of potential portfolio outcomes. By considering the historical standard deviation, returns, and correlation of asset classes, Monte Carlo simulations simulate various market scenarios and assess the impact on portfolio performance. This helps investors evaluate the robustness of the portfolio and understand the range of potential risks it may face. It's important to note that while standard deviation is a widely used risk measure, it has limitations, such as assuming a normal distribution of returns and not capturing all types of risks. Therefore, it's advisable to use standard deviation in conjunction with other risk measures, conduct sensitivity analysis, and consider the specific characteristics and constraints of the investment universe when utilizing it in portfolio optimization models.